you're talking to a conglomerate, a Sanyo or a NEC or a Hitachi, you need to be able to have a strategic dialogue with CEO, CFO, senior decision makers, really about their business challenges, about their portfolio, about what businesses are core and non-core, and then you work into identifying the non-core carve-out assets that are interesting to a private equity investor, and specifically to Longreach as a private equity fund in our focus areas. And so what we demonstrate to the seller is that we are a safe pair of hands. We have the expertise, the track record, team, the execution ability, the global sector expertise to safely own that business and make it a successful business. So I think there are three where the main carve-outs are happening. One is mature industrial businesses. So we've bought from Hitachi, for example, via Mechanics. That's a machine that is a precision, it's a company that makes precision machines that drill holes into printed circuit boards, laser beam, spindle drilling, very precision technology. Not high technology, not venture capital, but not commoditized technology, but mature, established precision technology. And we've got a few of our portfolio companies in that space. I think the second area which has become very active in the last few years is consumer. So in that area, we carved out the first kitchen business from Suntory. We added Wendy's to that. We are seeing more and more big consumer companies, conglomerates, selling off their non-core, very attractive consumer assets. The third area, which is quite well established but still growing well, is in services. So we've done one logistics carve-out. We carved out Sanyo Logistics and turned that into a third-party business, exited it. We acquired NOC, which is a business processing outsourcing business, BPO business, from Olympus, which is obviously a well-known electronics conglomerate. Yeah, I think it is, but I think the real structural issue is Japanese conglomerates are finally facing significant reorganization, restructuring decisions. They have to go more global. They have to compete with Chinese and Korean competitors in particular. They have to defend their strong businesses globally against aspiring competitors from Asia. So they must be more profitable. They also need to focus their capital, their capex, their R&D, their investment in narrower business lines where they can win globally. And so they're shedding broader businesses where they just don't want to be too diversified and when they can't grow and compete globally. What we've done here is we've acquired a existing platform, 135 well-located quick service restaurants, First Kitchen, well established. We bought that from Suntory. And then we're able to put together a very tailored franchise agreement with Wendy's. So we can convert those 135 stores into a new upmarket burger, pasta, salad, casual dining concept called Wendy's First Kitchen. So what that enabled us to do was to solve an issue for Suntory, which was a classic corporate carve-out. They're a pretty traditional, very Japanese seller. It's the first time they'd sold to private equity. So we had to do that in a very local way. But then we also needed to convince Wendy's in the US that we were a trusted and credible partner for them in Japan. Japan is a very, very important expansion market for their global strategy. So they couldn't simply trust that to anybody. They needed to know Longreach could do that. So we did bridge two very, very different cultures. We're very focused, so we're not competing broadly for deals in China, but what we do have is a controlled buyout focus. We have a sector focus. We have a very strong hands-on value creation focus. So we only do 6 to 8 investments per fund. So we're very hands-on. And then we have differentiated Japan capabilities. So we can look for companies and do controlled buyouts of businesses. Typically we'll be looking in Taiwan or Hong Kong, mid-cap deals in our sectors where those skills and our Japan linkage can add differentiated value.